With the buzzing business news stories of the day, I'm Vikram Oza here on ET Now. You're joining us for Business at 9 this evening. First, about the markets, we've seen the bears stay in charge on Dalal Street. The Nifty has declined now for a fifth session in a row, which means now it's down 3.5%. And today, at the close of the session, it went close to 19,100, which is the lowest it's been at since the 30th of June this year. Even the broader indices have mirrored the benchmarks. They've borne the brunt this time, and midcaps and small caps. If you look at the midcaps, they're down 5.3%, small caps too down 4.6%, and all of that has happened in the last 5 days. So what's the reason for this bear grip? Let's find out. Sunil Subramaniam, the Managing Director and CEO of Sundaram Mutual, is with us. Mr. Subramaniam, good to have you with us, as always, to get your perspective on the markets. We've seen these crude prices. They've eased off a bit at the start of the week. How do you see this correlation between crude prices and the kind of consolidation that we are seeing on the Nifty play out from here?
So I think it's the spot crude prices may ease up based on local announcements. But if you look at the forward crude expectations, I think they remain on a firm stage, both because it's winter setting into the US and in Europe, and where the energy heating demand for homes goes up. The Israel-Hamas conflict adding to the statement by OPEC that there will be at least a 3.5 million barrel shortfall for the Q4. So I think the short term, because of China's slowdown or something like that, there may be movement in the spot crude, but otherwise I expect a firm crude trend. So that affects hedge fund flows into countries like India, because we import 83% of our crude. So they take a forward view, because what happens when crude firms up is that our currency comes under pressure, and our trade deficit and fiscal deficit come under pressure, as well as local inflation. Because if government chooses to do a windfall tax or excise duty cut, only then will inflation not get affected. So I think multiple of these factors tend to lead hedge funds into profit booking from a commodity importing country like India and reallocating that to commodity exporters. On top of that, Vikram, is the fact that December month, as it approaches, you see hedge funds booking profits to pay their fund managers bonuses. And if you look at where they can book profits, is from those markets where they make good returns. So one of the few emerging countries to have delivered positive returns to hedge funds has been India. Hence, you can expect that there will be some profit booking, and some of them may be coming a bit ahead of the curve. The third is probably a sense of nervousness around the state assembly elections coming up on December 3rd. The results are due there. So I think a little bit of wait and watch in terms of what that signals for a parliamentary election, a little bit of uncertainty. And finally, the monsoon, right? The Rabi crop, the reservoirs aren't very greatly filled up. So there is some concern around whether the Rabi crop would be sufficient to have inflation under control in the first quarter of the year. So all of these put together are leading to a little bit of uncertainty. And hedge funds, when they sell, they're largely selling large caps, because when they take a country risk like India, they don't like to go down the cap curve. But what happens is that when those large caps get sold, mutual funds from their diversified portfolios, they like to buy those large caps. We're coming down to reasonable prices. Like you mentioned, about 3.5% down. So some stocks are down even more. So this they do by selling mid and small caps, because large cap funds haven't been getting positive net flows since the beginning of the financial year. So mutual funds, if they want to buy large caps, will need to reallocate the mid and small cap out and get the large caps in. So that's why if you see, the mid and small cap indices have fallen more than the large cap indices in the same period. So that, I think, overall sums up the situation, that given a lot of nervousness around these things, there is a little bit of profit booking and a reallocation of FII money.
You're talking about the mid-caps and the small caps, Mr. Subramaniam. These indices have outperformed the benchmarks this year. And why in the last 6 months, both these indices have moved up about 35-odd%. So do you see a trend reversal now coming up as investors now turn averse to risk, as it were? There is this amount of profit booking that's taking place. Are we in for a correction in the broader markets, which could be significant?
Yes, I think we are in for a correction and volatility in this broader market, but it's not because investors are turning risk averse. It's because FIS are selling large caps. Mutual funds, in order to buy those large caps, need to sell mid and small cap. It's not necessarily a reversal of risk attitude as much as the opportunity to get good quality, large companies at much reasonable prices. So it's just a reallocation. I wouldn't say there's a fear, because in the medium term, mid and small caps, I believe, will live up to these valuations. And for a long-term investor, in fact, the ongoing correction could be a good time to accumulate.
You did mention the commodities. When you look at the metals specifically, they were outliers on the back of news of those Chinese stimulus measures, like raising their sovereign debt. How do you think the metals are going to do from here?
See, I think the metals are related to the Western world, because China, in turn, is a manufacturer, supplier to the Western world, right? So China being demanding commodities, the stimulus alone is not going to help. The Western world, Europe is still not yet come out of the throes of a slowdown and a recession. US GDP numbers are looking stronger, but largely driven by a consumer boom. So I think the manufacturing cycle, if even in the US, the manufacturing PMI is not growing. So I don't see commodities as a very strong play. I see commodities generally easing, barring oil, for the next 3 to 4 months during the winter. Rest of the commodities, I think, will be on a more of an easing mode. I don't see a big commodity revival in the near term.
Specifically on the financials, do you see the biggest fallouts in this consolidation to be the banks now? Should we expect deeper gashes on the banking counters? Where would you see the bank Nifty head from here?
So I think there are two things here. So first of all is that when passive ETFs, which are based on the MSCI Emerging Market or MSCI India Index, when they sell, the banking and those stocks are about 35% of the index. So naturally, selling pressure comes in due to FIS selling on the banking sector. Second point is that the expense that you've seen, that the NIM widening which happened post-COVID has probably now saturated, because the low-cost funds that banks raised during COVID and the lending that they were able to do, when their NIMs kept on expanding. But today, most of those low-cost funds have been utilized in lending. The fresh deposits are coming in at much higher costs. And on the lending side, while the retail lending is going strong, the corporate lending, other than the government doing infra, private sector CapEx is still a promise yet to happen. It will happen. It's not a matter of if, only when, but only when that picks up will you see that the loan book multiplied by the NIM will still make up for a good EPS growth. So from a medium-term perspective, I think bank EPS growth will be strong. But in the short term, given the rate of growth of widening of NIMs, which was there in the past few months and years, that same widening may not be there. So there will be a plateauing there. The second point is that there have been a little bit of noises because RBI has been talking about NPAs on the worried about future NPAs on the retail lending, which is booming. So I think some little bit of thought process around if banks are overexposed to retail, are they going to see a future NPA, is bringing a little bit of a valuation correction. So on the whole, I would say on the short term, the bank index will suffer a bit of volatility given these short-term thresholds. But again, from a medium-term perspective, any revival of the capex cycle will mean a strong growth in the loan book and more than compensate for the non-expansion of NIMs further. So I think overall, I'm not worried about banks from a medium-term perspective, and any corrections in the bank Nifty would be a good opportunity to buy.
And how do you see the ratio panning out for investors between debt and equity? We've seen the bond markets buzzing. Is that going to take a continuous bite out of the bulls? Is it time to play defensive right now in equities? How do you strategize at this time?
See, defensives and equities is a good play because, like I said, large caps tend to be the defensive stocks. FIs, if they're selling large caps, those are becoming more reasonable valuations. So a shift into defensives is probably a good idea from a shorter term perspective. That's number one, but not necessarily into debt, because the reason I say this is that all of these factors that we speak about are very short term, maximum 3 to 6 month time frame. So from April, May onwards, with summer coming in, I expect oil prices to ease. I expect government to have brought inflation under control, RBI in a much more positive growth supportive frame of mind, and markets could in fact touch lifetime highs before the elections. So if based on just a 6 month volatility, you want to make a shift into debt, because debt no longer carries the taxation benefit, post the finance bill. Remember that. So to that extent, I'm not sure that it's the time to just shift equity allocation to debt because of this. I would rather say do a staggered allocation into equity spread out over the next 6 months so that every volatility and correction can get you, from buy low, sell high perspective, you will average your holdings. So buy equity smartly, do add defenses to your portfolio over the next 6 months. And then from then onwards, you can reshift to a growth oriented. There's no need to reallocate to debt just from this short-term volatility that I see ahead of the equity markets.
That's sage advice. Sunil Subramaniam, always a pleasure getting in your thoughts on the markets and the way the markets are moving in recent times. We've seen that disaster play out over the last 5 days. And of course, that kind of consolidation, you've set aside those reasons for us. We'll see how much of that remains in play and how much deeper a correction we'll see in these markets. Thanks very much for joining us, Mr. Subramaniam.
Thank you.